India has about 200 corporations. So far, only about 22 municipal corporations who've reached out.
And the amount of money raised by US municipalities, it's so huge compared to India.
You are comparing with US, and US has been more than a 200-year market, and we have started barely this about 25-30 years.
I would want to see a future where retail participation should come in.
Nobody is going to take pride in all of these bodies also. People tend to shy away.
Is it cheaper for a municipality to raise money from the public markets or go through the banking route?
So till the time the volumes don't come in, the liquidity will not come in, and if the liquidity is not there, it starts reading into the pricing.
Hi everyone, welcome back to another episode of the Subtext, and today's guest is Rajashree, who is Senior Director at CareEdge Rating. This conversation, we'll be talking about municipal bonds. To set you some context, on the Daily Brief, we've written a lot about municipal finances, right? I personally am really fascinated by how states, countries, and sometimes even municipals like BBMP or BMC manage their finances. Where does the money come in? Where does it go out? And a question that comes often during those conversations is how do they finance a lot of it? A lot of the times, all these municipalities depend a lot on the money that comes from the states, which is called devolution. But lately, a lot of municipal bonds have also started going mainstream. Municipal bonds are a very big deal in the US, but in India, not so much. And this conversation, I just wanted to talk about that. That's one angle. Another angle is that municipal bonds is also a potential area where retail investors can invest their money, which is why we decided to talk about municipal bonds. That's all the context. I'll give it to you right now. Let's head into the conversation.
Thanks for having me on this call. So yes, this topic definitely entices us, and it's been something that the markets have been chasing it for at least for the last 2 years. They've not really found that buzz before that as much as it's happening in the last few quarters.
So honestly, I want to get to that because I saw 2026 numbers, the number of issuances have suddenly picked up. As soon as they did, I remembered reading a report from you where you were very bullish about the fact that 2025, 2026 will be the year when these things pick up. So I'll talk about that. But before that, let's take a step back and why don't you help me understand, ma'am, what do you do at CareEdge? And I read on your LinkedIn you've been with the company for 20 years. That honestly intimidated me, but I still hope I don't bore you with my questions. So first thing, I just want to understand what you do at CareEdge and how is it that you are heading the infrastructure rating department, but at the same time you're also looking at municipal bonds and you do all of that research. So where does that overlap come in?
Sure. Too many questions in one go. Yes, you're right. I've been with Care Ratings for close to about 20 years and pure play in the ratings space. For the last 5-6 years, I have been actually looking more closely into the infra space. Currently, I'm the senior director who heads the corporate and the infra vertical for certain sectoral segments. Municipal bonds and the urban local bodies also form part of that whole portfolio. Largely, otherwise, it has been, a transportation and a power transmission, data centers, EPC, most of the new age kind of infra businesses, airports, airports, etc. So municipal bonds or the ULBs per se have been with us for last 2 years, especially I'm talking of my portfolio point of view. And what we essentially do is we evaluate the creditworthiness of the issuers, basically whoever are the corporates or the issuers who are willing to avail borrowings from the banks, the traditional finance, or who wish to tap the capital markets. So typically the investors or the lenders, they do have a requirement of getting those credit facilities rated, and that's where we come in to picture. So that's about it. And I think my timing into the municipal finance in terms of a portfolio has been pretty good in terms of the lot of action that we are seeing in the last couple of years.
So, ma'am, I saw that I understand what CareEdge does as a rating agency, but at the same time, you also publish a lot of research. So, I'm assuming all of this research reports that you put out publicly feeds into the rating. How does that look?
Okay, so as you are aware, so when we look at certain portfolio, be it sectoral, if we are looking at say a telecom sector or we're looking at a real estate portfolio, etc. So while we do the entire assessment on an individual issuer level basis, we are also required to look at the sectoral industry level insights and what are the events which are unfolding, because eventually that is what is going to also impact the entire evaluation evaluation process. So what we do as a team is, while we do these typical specific rating assignments, we also try to build on that assessment and the knowledge that we absorb through the process, and we try to come out with some kind of opinion pieces and outlooks, because in any case that even the credit ratings are prognosis, right? So be it research, it has research and analysis both put together. So this kind of overlaps from that point of view. We are not doing hardcore research in that field, but because we tend to deal with a lot of ULBs as a part of our routine process, we try to use all of that and put out some opinion pieces, which we hope are quite meaningful.
Ma'am, they indeed are, ma'am. And honestly, for the past year or so, we've written our newsletter. Every time we've talked about municipal finances or bonds, I've always gone back to your research only. So that publicly available information is honestly a gold mine, at least for me. So thank you for that. That said, ma'am, I understand when I got introduced to finance, it came very intuitive to me how companies would get rated for their credit worthiness, because we get into finance, we look at balance sheet of a company, a P&L of a company, a cash flow of a company. It starts making sense intuitively. But when we talk about analyzing the finances of a state body, or let's say a municipal, it doesn't come very naturally to me. So my first very basic question is, when you go ahead rating these entities and eventually their issuances, how is it different from rating a corporate entity? What exactly do you look at? If you could just walk me through that process a bit.
Sure. While we do have a published methodology for municipal and ULBs, which is there on our website, I'll try to make it a little short and simple on this call. So you're right. In terms of corporates, there's a lot of published data, or there are some standard methods how they are released, at least the financial documents and the entire operating level info. They are pretty much known to a lot of investor fraternity. In terms of municipal finances, in fact, the core domain, the work that they do is much different from what a corporate does, right? So that's the first basic distinction. And therefore, the method that they adopt to keep all this information and the MI systems are way too different, be it from their financial accounting practices, be it even their operating level, data points. When we say operating level, because a municipal corporation has various, the responsibilities are way too different. They're not necessarily from a profit-oriented kind of, ventures. So, which is where we would be required to understand what is the responsibility of the municipal corporation, how have they been operating over the past few years, what type of fund raising ability does the municipal corporation has. Basically, the economic base, the municipal corporation will have its own economic base, whether it's industrial or is it agricultural. So that gives a flavor as to whether the municipal corporation will have an ability to kind of levy additional charges or fees or taxes. Typically, we may be aware of this property tax and all of that which a municipal corporation would be levying in those area. So prima facie, we would look a municipal corporation into two broad categories. We try to evaluate what are their financial parameters, which are also equally essential, and then the non-financial parameters, which is where the distinction lies. So you try to look, as I said, the economic parameters, what is the administrative capacity of the municipal corporations, what has been the track record in implementing projects, if they have been undertaking projects, what is the methodology, the design capabilities, right? The legal framework under which this municipal corporations would work. And the financial parameters in any case would delve upon their entire, the tax base. Suppose if they have a very strong economic base, they will be in a position to levy good amount of property taxes. So once they have levied, are they in a position to even collect it? In simple terms, the collection efficiency. So one is their role, they're empowered to levy taxes, and the second is, are they actually able to get that? In case if that ability to generate own revenues, as we term for most of these ULBs, if that is limited, then what happens is these ULBs typically tend to lean more on the states, state governments and the state finances, from where they get some periodic transfers and some devolutions happen. So this is the whole pattern in the financials that we look at. What is a fund flow? What is a fund outflow? And more importantly, when we are evaluating from a credit worthiness point of view, the indebtedness definitely comes into play. So there are certain budget accounts which the ULBs would provide. We'll try to compare what have been the budgeted and vis-a-vis that what has been their actual expenditures, actual fundraise, project related development. So this is pretty much different. What we have therefore done is we've created a information memorandum which is pretty much unique and highlights what is a requirement for all these ULBs and municipal corporations, so that it's easier for them to kind of arrange and prepare. And we also have a fairly ready and a steady state compiled data piece from these ULPs.
So, from what I could gather here, is data collection a problem for you? And do the accounting measures also affect you? Where I come from is, if I'm, let's say, looking at a corporate entity, it's very easy to get access to their financial data. If it's private listed, we can get from MCA, publicly listed. So that's one thing that's bothering me. Is data collection really an issue? And also, is data consistency also an issue? Because from whatever little I read, some municipal bodies go for cash based accounting, some of them go for accrual based. First of all, I couldn't really make sense how exactly are they different. Is it similar to how it happens in corporate, cash and accrual based? And is that a big deal for a credit rating agency like you who's trying to rate? So if you could give me a view on that.
Sure. So I think your questions are twofold. One is the data, whether we get data easily, and the second is the method of accounting practices which they operate, right? So data definitely has been a challenge for majority of the ULBs even as we speak, right? So okay, where the shift has happened. Now, when the municipal corporations went about going for bond issuances, now bonds per se are very sophisticated instruments, and you have in fact investors who are far more sophisticated. So the disclosure norms, be it from the regulatory side, from the investor side, is far superior. So corporations who've been able to tap the bond market, they have been kind of acclimatized with the entire requirement. They have got their entire teams strengthened to ensure that all these disclosures and the data submissions are pretty much on track. So we don't really face too much of an issue from those corporations. The new tier 2, tier 3 and some of the other smallish kind of corporations who are pretty much new into this whole space, they definitely have a fair bit of challenge in terms of not just their bandwidth to manage that kind of large volume of data requirement which we insist, and more importantly also on a periodic base, on a regular basis, as you said. So once we rate, if the facility is outstanding, we require to monitor it till the life of the instrument. So which is where the entire information exchange and updations that is required to be furnished to a rating agency on a periodic basis. This is a fairly uphill task for most of these smallish corporations to comply with. So yes, I think that definitely is one big gap that we observe. Second, on the accounting based system and how rating agencies attach importance to that whole piece. So most of the ULBs, as we see, they are still on the cash-based accounting. Basically, that kind of depresses or kind of understates the liabilities which the ULBs have. So when we look from a rating standpoint, we can rate only to an extent what we can see, right? So in case if there is opacity in the information that comes, or disclosures that comes, or inconsistency in what they are providing to us, then that kind of leads to a more conservative assessments in many ways, and also may hamper the outcome. So definitely from a rating agency point of view, we do attach a lot of importance what type of accounting practices, methods are being deployed by these corporations, whether it is accrual based or cash based, because it has an impact on the overall assessment.
So, ma'am, my next question here being, are municipalities, I'm assuming whenever there's problem with the exchange of data, which would be consistent across other rating agencies as well, are municipalities receptive to it and they want to do the hard work there, or they are fine with relying on the state devolution and state transfers for that money? Because in the end, they do need money. And if there's a lot of friction in raising money through public markets, they might end up going back to the states. According to you, how do they approach this problem? Because I'm assuming this is a big enough problem for them, stopping them from raising money.
See, there are two things. When we look from the point of view of municipal corporations, it's not that they are averse to disclosures. I mean, it's not that they want to show that they are having any kind of a hesitance or unwillingness to provide data. That's not story here. The point is they are incapable because of the vast requirement, and there is a lot of historic data also which is required. When we start a particular case, there is a 4 or 5 year data. Then we look for business plan and of financial projections. So this does require a lot of number crunching and collation of very granular data. So it's more of their team capabilities that they have, which also drives that kind of resistance or some kind of a lacuna in providing data. The second thing is most of these are also wanting to tap the markets because somewhere in the last 2 years there has been a lot of policy push, regulatory push. Forget about the Amrit incentive, which was one of the big game changer some years ago. Even as we speak, this year budget also has laid a lot of emphasis on this municipal corporations and their bond market raises, so that there is a higher amount of incentives which are attached. So there is a push effect which is largely driving all these corporations to come forward and get their financials pretty much realigned so that they are market ready. Basically, that discipline has to be instilled in them. So far, you're right. Their reliance on states, especially the smallish kind of corporations, had a good amount of reliance on the state finances and also the traditional banking route, which have not been very cumbersome for them to handle. When the moment you switch to a capital market, then there is a big change. I mean, it's a cultural shift even for them, right? So that's where the whole things are lying. But what has really happened, and it's very encouraging to see, is now we are actually seeing some of the smaller corporations also participating and coming forward for a bond raise. Some of the intermediaries are also helping merchant bankers. So many outreach programs which SEBI has been undertaking for the last 2 or 3 years. All of these are actually started yielding results because that understanding has developed, awareness has developed. Investors are also reaching out to all these smallish kind of corporations. So I think things were improving, but they are on a very gradual pace.
I agree with what you said with Amrut and even what we saw in the last budget. But if we were to not take that push into consideration purely from a cost of fund perspective, is it cheaper? Again, this is a very, I don't know, crude question and whether you can answer, but is it cheaper for a municipality to raise money from the public markets or go through the banking route? Or there is no easy one way answer to it?
See, pricing will be a function and will always remain a function of demand and supply. Right. So when we look from the bonds point of view, so far you're right. The policy push has been the biggest game changer, and that has incentivized them enough to tap the market. But then where are the volumes? The incentives have a certain cap and it restricts them to go beyond 200 crores. And therefore, we see most of the corporations when they reached out to the capital market, their bond issuances have not be crossed 200 crores. So far, only about 22 municipal corporations who've reached out. India has about 200 corporations. Where are we, right? So the numbers speak for themselves that there are not too many municipal corporations who are actually tapping the market on a frequent basis. Very few are, doing that. So till the time the volumes don't come in, the liquidity will not come in. And if the liquidity is not there, it starts reading into the pricing. So the market today, if, broadly, whatever pricing that we see for the municipal bonds, which are definitely high rated, there will be a variation or a deviation from some of the other corporate bond issuances in the same rating category because they do attach that bit of a slight illiquidity premium to the Muni Corporation bond issuances. So that's where the bigger thing is. Second, in any case, is the awareness, which will have to develop only over time.
That leads me to the question, who are the buyers of these municipal bonds? I understand when I was reading that municipal bonds either get privately placed or they can be public issues. If I remember correctly, most of them have been privately placed. Public issue itna nahi hota, which is also why retail participation in this is very little. And this is slightly discouraging because when I saw the numbers and the amount of money raised by US municipalities, it's so huge compared to India. Again, that's not a right comparison, and I understand. But I would want to see a future where even in municipal bonds, which are such highly rated and also are very rewarding financially at least, retail participation should come in. So my larger question being, who are the current buyers and what does it take to have retail come in more?
I think this question, especially the second part of it, has been raised across so many forums that we, deal with, saying how does a retail participation improve from where we are right now. Presently, you're right. The institutional participation is what is actually holding up the entire capital market instruments for municipal corporations. Largely, they'll be in the form of some insurance companies, some pension funds, very little mutual funds. Even banks are not too very heavily into this side of it. It's largely these two, three segments that we see who are participating in the whole bond raises. And again, they would be not able to tap too much because there is no major issuances which are forthcoming time and again from the municipal corporations. So that is where, and their ticket size is also very small. So if a 200 crore bond issuance comes in, and if there are 3-5 investors, you can imagine what each one is likely to hold. So it doesn't really entice them so much to participate in all that, but for lot of policy and the regulatory push that they have to participate and encourage these smaller corporations to come through. For retail participation, things are still the same. Volumes are required for any retail investor to come in. Besides awareness as to what is the outcome of investing in this, what should they expect when they invest in such kind of bonds. While there have not been any mishaps in the bond market from the municipal corporation so far, so that's fairly safe instruments. Yet for the retail participants, the awareness has to spread out. That has certainly not really come up the curve as much. And the issues which are also, hampering the institutional investors about volumes and liquidity, somewhere that is what is also playing out on the retail participation. You are comparing with US, and US has been more than a 200-year market, and we have started barely this about 25-30 years. So we are not at the same footing. But yes, retail participation is the way forward, because till the time that ownership level kind of or this involvement is not there, possibly nobody is going to take pride in all of these bodies. Also, people tend to shy away from these instruments.
So, ma'am, if I understand it correctly, talking about institutions like larger mutual funds, pension fund money, insurance money, these guys, these big buyers look at municipal bonds at par with corporate, and they don't mind investing here. But one of the biggest problems for them is that municipal bond market has much lesser liquidity than corporate bond market. So eventually they end up going in that favor. Is my reading correct here?
Yes, pretty much. As I said, because the ratings, by and large, when we provide, the ratings are not too different from the corporate bond issuers. That's because of certain structures, etc. So they are pretty much at par. But the pricing is what the investor perceives in that particular instrument. And there, the illiquidity related premium is something that plays a fairly large role, possibly from the investor standpoint. But the deviation has not been too high, or the spreads have not been very different from their peers. When I say peers, as in a Muni bond rated X with a corporate bond rated at the same level, the deviations are not too very high, but they do exist.
I understand that the corporate bonds are being priced relatively similar to municipal bonds. One thing that I want to understand here is, obviously there is some illiquidity premium, but at the same time, there are a lot of partial credit enhancement tools being used on municipal bonds. We have escrow accounts, which sort of give some comfort to investor. At the same time, I was also reading how recently in the latest consultation that SEBI put out, they're trying to push for more SPV structures where multiple municipal ULBs can come together. And so all of these things, I think, are a way to make the buyers feel more comfortable about the risk that they're taking. Plus, I'm assuming there's also a tinge of sovereign guarantee there. Even though we've never had a mishap, and I hope we never do, I think that sovereign guarantee, or at least the belief that there is sovereign guarantee, does give a lot of comfort to the buyers. Does that also influence them to, let's say, have more exposure? How much of that plays a role in an investment decision of a big institutional investor?
across all the municipal bonds that we do or we see in the market which are there, they all have a fair play of their own strong credit profile. Basically, when we look from an assessment point of view, it's a bottom up approach. So we look at the municipal corporation and then you look at the structure of the particular instrument. So in case of municipal bonds in specific, if you see their credit profile, especially the ones who've been able to tap the market, their credit profiles have been fairly strong. And when I say strong, it basically reflects that they have good own revenue kind of generation capabilities, which are very strong. Collection efficiencies may be higher of 85-90% and things like that. So the cash flows are quite robust. But from a bond investor point of view, they are not looking at anything like a loss given default approach. They look at a PD approach, the probability of default. So it's very important that there is no mispayments on the due date. Correct. Eventually, there can be a method to recover some money or the dues that is way different. That's not the approach what the investors look for. So therefore, all these bond issuances that we see, they do have a specific structure wherein they are backed by an escrow of some of the strongest cash flows of the municipal corporations, which predominantly has been property tax, and that's where they try to ring fence those kind of very strong cash flows and protect the repayments of the bond, and which is how the confidence of the investors are pretty strong. I mean, the moment they have a visibility of the cash flows coming through to service their debt servicing on time, automatically, their entire confidence on the instrument kind of increase multifold, irrespective what can be the other issues at the issuer level. Maybe the service area related parameters or factors have not been very adequate. They may be just moderate and so on and so forth. So there can be multiple other factors. So investors definitely are eyeing on the structure when it comes to bond markets, and they do uplift the ratings when we also evaluate, right? That's pretty much critical. Now, the partial credit enhancement which RBI introduced, and it said you can go about extend it to municipal bonds. That's been a concept which has been permitted, but it is yet to take off very rapidly and on the market front. How a institution can lend a partial credit enhancement to a muni bond and the mechanics out of it. So that's something we will have to evaluate. But in any case, most of these municipal corporations, as I said, they do naturally get some bit of an uplift from their standalone levels. And in any case, the current structures also are doing something similar where you're carving out a bit of cash flows. There is no external credit enhancement in the municipal corporation. So the current structures that we are looking at, they are all internal prioritization, ring fencing, and clear covers and reserves which are being maintained for the bonds. The PC framework which RBI has introduced is an external credit enhancement. Basically, an external entity will provide a line of credit towards that bonds. So that's yet to kind of, something that we'll have to see how it takes off. But it's definitely a welcome move that the ambit has increased of PC framework. They are including even muni bonds in that structure.
Okay, so now let me throw a very difficult question to you. Something I thought I'll say for the last, but since we are just talking about this, from whatever conversation we've had, it looks like a very circular problem to me. For us to have more issuances, ideally, we should have more buyers. Buyers are wanting liquidity, and they also want more issuances because they have an appetite to invest more, but we have just a few issuances every now and then of 200 odd crores, and they want to invest more. But at the same time, we have some problems on the issuer side where, if not the unwillingness to raise money, but there are some structural reasons why we are not seeing a lot of issuances, although the pace has picked up. So this circular problem, I don't know, how do we start the snowball? Who gives in first? Is it the buyers who are willing to absorb all the liquidity and are all in to make sure that the market matures? Or do we see something happening from the supplier end where we have more and more issues coming in, maybe through a SPV structure? Or just recently, I also read that BMC, the largest municipal corporation of India, they're also planning to raise money. How does the cycle start? Because I'm assuming the only way for liquidity to come in is when both the demand and supply play their role. So how does that happen? I know it's a very difficult question and no easy answer, but I just want to know, how do we do it?
Yeah, so My opinion on this is yes, both the factors have to move in tandem. Nothing works in isolation. Neither the policy incentives, alone can make the difference. They can only nudge the corporations to come forward and take that whole, bite the bullet and hit the capital markets. So the policy push is important from the point they are the most required enablers to ensure that it is favoring the municipal corporations to come forward. So the push has been, and that's where I think possibly we are seeing a recent set of frequent issuances or repeat issuances from the existing municipal corporations. It adds to the confidence of the investors. It also nudges the smaller corporations that this is not just restricted to only getting incentives. It is also about a fairly reliable mode of raising finance. So that's the confidence which gets passed on to the smaller kind of corporations. You mentioned Mumbai planning to even approach the capital market issuances after such a long time. It only adds more credibility to the whole space. The investors also will, prefer to participate in large issuances, and that's how it's a market making kind of an exercise in the long run. For smaller corporations, actually, what is important is not just lapping up the incentives. This will actually help them improve their financial discipline, clear up all of those things which they have been struggling with for quite some time. Those issues will be kind of settled. Possibly, if there are some intermediaries who can help in the capability building of all these small corporations, beside pooled finances, these corporations in isolation may not be able to attract any marquee investor. But what definitely will add value is when most of these smaller corporations come together, they form some pooled finances, and then the quantum of the bond raise also is pretty large, and you will have a fairly diverse number of investors who can participate. So this is how the way forward will be. And I don't think the policy push or the incentives are going to die down soon. But it's important that this whole framework or the municipal bonds don't just rely on incentives. They'll have to look for a structural shift. It has to be, structural shift which can help them be more strong and avail all of these capital market resources rather than just relying on the incentives, which to an extent helps them. But yeah.
I think SEBI is doing a lot, government is doing a lot to make the finances of it make sense. But yeah, they're the enablers. But then I also believe that the structural and the inert willingness should come from the municipalities themselves. And that is a problem very difficult to solve because, as you mentioned earlier in a conversation, it is also a cultural shock for all these municipalities who've never accessed capital markets ever, now being asked to create all these accounts and go access that market. And I don't think that's a behavior change that happens in years. I think it might take a decade or so. I don't know how far are we, but that's just my honest read on it. I think adding to that, I have one more question about green muni bonds. So we had Ahmedabad, Pune. It's very natural for all the municipal bond issuances to also have a green flavor to it because a lot of that money goes towards building, let's say, water infra and a lot of themes which might attract investors who want to invest in green. Is this again a very small trick of the trade to make it more attractive, or can it fundamentally change how investors look at, let's say, muni bond issuances?
So it's a blend of both. Uh, Inherently, all the municipal corporations or the ULBs, for that matter, do have a large scope of their work which is related to the ESG norms or the environmental and the social, which have social impact, right? Be it building schools or water and sanitation, transport, you name. They all of them kind of qualify for some of those ESG related initiatives. But let's not forget, what are we eventually saying? We are looking at capital market or a bond issuance. So effectively, the repayments have to come through from a steady state, visible cash flows, which you can, which are quite obviously, predictable. The underlying corporation also has to perform. It can't just be a green bond for the sake of it. In India, for now, there has not been a huge commercial advantage which one can associate with issuance of green bonds or blue bonds. For now, I don't think we've seen that kind of a huge distinction or an incentive. Possibly this is only a method to attract investors to start with, who have certain mandate to kind of invest only in green bond or a blue bond and things like that. and at the same time ensure that the underlying proceeds of all that fundraise is deployed in that particular process, right? So that's I think is extremely critical, and if they're able to drive that, then it becomes an auto cycle. The moment the municipal corporation delivers or in any of these service deliveries or provides good infrastructure, but naturally the rest of the things also fall in place. Its ability to levy new fees and the collection efficiency, because people who are there, they are seeing the actual difference in how the municipal corporation has provided service delivery. So it attracts constantly better improved cash flows even for the corporation. So green bonds, I think, is just an additional layer how the municipal corporations can do in terms of fundraise. But I personally think green, blue or red, whichever way you may look at it, the first important thing which needs to happen is their fundamental credit strength, and the MIS discipline has to come in. Then the colors can keep adding, however we may want to look at.
It's a good segue for us to now just talk about municipal finances, right? And that will be the last section of our conversation. Here, what I've observed is in India, at a municipality level, the amount of spends that they do as a percentage of GDP is, let's say, a couple percentage points, whereas the amount of freedom to spend in US and China is much higher. Is that also the reason why, let's say, municipal issuances are not happening? Because if, let's say, municipalities don't really have a freedom to spend a lot, they don't end up taking a lot of money and, let's say, issuing these bonds. And maybe partially also not a lot of work happens at a municipality level compared to, again, the caveat being compared to US and China. So my question be, how do you look at India's state of municipality spending compared to US and China? And does that funnel into the reasons why maybe issuances are a bit on the lower end?
So are you referring to the availability of capital and deployment of capital at the municipal corporations?
Both. Deployment of capital first, because if, let's say, we are not spending as much as a percentage of GDP, which would eventually mean that maybe municipality, especially the tier 2, tier 3 ones, are more than comfortable relying on state devolutions. Is that one of the, again, this is just a theory I have, but like, do you validate it? Do you think there is any merit to it? Is there a way that for us to have more issuances, maybe municipalities should be given more leeway, more flexibility to spend as freely? Because again, that becomes a part of a larger question of how do we approach the political economy of the country. We won't comment there, but how do you view that?
Yeah, see, you're right. In terms of the autonomy which is given to these municipal corporations is not as high as it ought to be. So when I say that, what I'm essentially referring to is they do have the responsibility to undertake, be it in terms of providing basic amenities, clean water, sewage systems, etc. So there is large amount of responsibilities which are already entrusted on the municipal corporations. Now, how do they go about it and how do they deploy the resources? There is a bit of autonomy which is not as great. So they will have to rely and take inputs from the state entities, and who would be kind of governing the budget spends, the timeliness, even in terms of certain devolution of taxes, etc., or the funds which flow in from the state governments. In case if they're not timely and if they're not adequate, then it kind of impairs how the municipal corporation plans its services per se. So there is a schedule which they would be required to undertake. That gets impacted if the clarity is not there about the fund availability to them in quantum and in terms of timing. So this is where there is a gap, especially in case of tier 2, tier 3 cities. The larger corporations per se are quite strong enough in their own resourcefulness and fundraising ability. Not that they are totally immune to the entire state entities or their involvement in the decisions, but they are still favorably placed. In fact, the municipal bond ratings, if I have to say, most of the times you may say that they are much higher than the state government credit ratings. That's because their own pool is quite strong, their own canvas is quite large, and they don't necessarily have to rely very heavily on the states. So coming back to whether the deployment at the municipal corporations, does that have to really pick up to give the proof of concept to the investors per se that, that how they're spending. The answer to a large extent is yes. But I think so far the municipal corporations have been able to establish, whoever have raised the funds, they have been able to establish that they have enough and more reasons to deploy, and they have been doing it quite well. The key reason, the key hindrance I see is scale. It's no longer just a mere proof of concept for the large corporations or the tier 2, some of the good tier 2 corporations also. It's more about scale. Till the time you don't get scale, you will not be able to solve a lot of problems for the other tier 3, tier 4 kind of, corporations. And which is where possibly the pooling can help. The aggregation and the pooling of some of those corporations will be the only way out, so that they learn from each other in terms of not just the basic requirement of accessing markets, but also the availabilities is pretty much stronger. Your bargaining capabilities are much stronger. The investors also will be able to participate in larger issuances. So it's more about scale is how I would say.
And ma'am, have we seen any actual interest on the pooling funding structure of it? Do we have tier 2, tier 3 municipalities coming in? Because I'm not aware. Do you see interest on that front, or you're still hoping that maybe that eventually comes up? Because from whatever little I know, there's no such issuance happened on the pooling fund structure, right? Even though the rules are laid out.
There has been long ago, in case of Tamil Nadu, there was a water sanitation pooling fund which happened, and that's kind of worked well. But yes, after that, there have not been too many frequent issuances or structures that we've seen from the pooling side. SEBI also has been quite vocal about this, how the InvIT structures and the pooled finance mechanisms should be taken up. MOVA has been also championing this whole thing. Urban Challenge Fund, for that matter, is the other method how they wanted to support all these smallish kind of corporations to come forward with some bit of a bridge finance and a bridge support coming in from the ministry themselves. Recently, we have interacted at various levels where authorities and the municipal corporations, they all have expressed interest about working around these structures, these pool structures, because this is definitely the way forward. Else we will not be able to involve some of the some of the remotely lying corporations which are there, which have been kept out of market for quite some time. You'll have to bring them. That inclusivity has to be there. And for that, this pooling mechanism is how it has to happen. There is discussions, and I think in some areas, some frameworks are also being developed for coming out with these pool structures. So it's not just restricted to a seminar discussion. There is action on the ground that we do hear from some corners.
So, ma'am, one of your team's analysis showed that the larger ULBs, their surpluses were growing at very healthy numbers. And even though that is happening, they continue to raise more money. As we even saw with Mumbai, they're willing to raise money, which is setting stage, and they're leading from the front for the tier 2, tier 3 ULBs. So that's very convincing. I don't know whether they could be doing more on that front, but we'll leave to that. When I talk about tier 2, tier 3 cities, has your team done any analysis as to what do the surplus growth rates look there? Are the surplus there convincing enough, or because they're not convincing enough, pool structure becomes even more important? What does the finances look for tier 2, tier 3 cities? And also, how do you view that in line with devolutions coming in? Because tier 1 ULBs are much more, they have the bandwidth and the freeway because they have the money. Just because tier 2, tier 3 cities might not have over-dependence on devolution, does that suppress them even more? How do you look at that?
You're right. See, in terms of our assessment, while we've not done anything like a threadbare analysis of tier 1 separated from tier 2, tier 3, it was more of municipal finances. But the observations or the output has more or less, aligned with what you have just articulated. So tier 2, tier 3 cities, merely because their own revenue generation has not been very high, but naturally, more than 60-70%, they are dependent on the state transfers. And in that context, that also suppresses the credit view or the standing of those corporations, right? Now, if we say, therefore, is it required that these small corporations necessarily have to come through a pooled route? It depends. Okay, we do see some of the corporations who have been able to make some changes in their whole method of functioning. They have taken some radical steps. The service delivery parameters have improved. Somewhere it also depends upon how it is led at the helm of the municipal corporation. The problem with the municipal corporations is also because they have a changing so-called commissioner who comes in for a certain period and then they leave. So there is a continuity related issue also which is there on the municipal corporations. So in terms of the retail, in terms of the smallish kind of tier 2 and tier 3 corporations, what we are essentially saying is if the pooling happens, their learning curve becomes faster and their confidence improves. And the moment they have complied with all the requirements, be it from the SEBI's requirement or from the investors' requirement, a rating agency requirement, and so on and so forth, their ability to handle larger issuances will only improve from there on. So at least to kickstart off, it's better that they come through a pool structure, and as they all stabilize and they are ramping up, possibly we will see more of individual issuances also. We will require that much appetite even from the retail and institutional investors, right? So I think that's the way forward. We'll have to start somewhere.
As my last question, I am thinking of an ideal scenario where we are at a stage where municipal bond issuances go up a lot. We have a lot of buyers who want to buy, we have a lot of issuers. For that to happen, for that snowball to start, for that chain to start, what's one thing, just one thing? It could be on a SEBI front or on a government level front or any front. What's one thing that maybe should happen for us to achieve that in the next 10 years? And also, counter to that, what's one thing that we did not do so right over the past 5-10 years, which we could change? So one new thing that you think, okay, that should happen, and one old thing that you think maybe we should change, that eventually sets us in the chain of reactions whereby 2035, 2036, we actually have a mature market. I mean, that's a very idealistic scenario, but let's start with that thought process.
See, it starts from the municipal corporations now. I think there have been enough policy directives and reforms which have come through to enable the market. So I think that directionally we are in the right space. We need to have now more structural changes happening at the municipal corporations. And for them to unlock this, it's important that they strengthen their financial discipline. That's the first ask. So it's not about just tapping the market and getting incentives and saying, that they have done that and completed the whole process. It's about sustaining that whole momentum. For that, they have to structurally improve their financial MIS, discipline, capability building, design, execution, etc. Say, suppose the municipal corporations undertake certain projects. They don't seem to have, not all corporations have that adequate manpower and design capabilities to undertake large projects through a PPP or on their own, right? So that capability building has to be very strong at the municipal corporations, so that they have the, not just the willingness or the ability is how we would want to improve. I think that's the key foremost area. Rest, all other things are pretty much in place. The investors are there. The markets are pretty much aligned to that extent. Municipal corporations have to up their game.
So you think that the Mumbai's raise, which I'm not so sure what the amount would be, but I'm hoping it will be around 1,000 crores, because then it will be lined with the 26 budget incentives, which they mentioned. Would that be a start of the era? And followed by Mumbai, which all municipalities you think should follow the route? Because you can't just rely on Mumbai's municipalities to keep raising money there.
All the large corporations, so Delhi in any case is there, maybe Kolkata can come through, Bombay, Mumbai corporation should anyways be there. See, it's equally important that they not just raise funds, they also deploy it, because as you may be also aware, recently there was a particular corporation in news wherein it was kind of contemplated that possibly they will be required to return funds because they have not been able to deploy it for the cause. Not that the bond repayments were at risk, certainly not. That's not there's no iota of doubt on the credit worthiness of the corporation or the bond servicing. It's about the end use for which the funds have been raised. Because we should not forget, these municipal corporations, when they raise money with some incentives, which the government suppose has announced, that goes into the cost. It allows them to lower their cost of funds to an extent. And effectively, if it is not deployed for the purpose that it has been raised, then it defeats the whole piece, right? I mean, they have gained incentives, but then it's not deployed. So I think it's important for most of these corporations who come forward to raise funds to not just set examples on fundraise, but also on how it is being deployed so that it can attract more investments. That's going to be critical.
Fair enough. I mean, ma'am, before I let you go, is there anything you think we didn't discuss about municipal finances or municipal bonds that we should have discussed and I missed? And that is very important to this discussion. That the floor is yours.
So I think, see, we kind of touched all through about the potential, about where the gaps are, what can possibly the tier 2, tier 3 corporations can do. And is there a way forward how we can unlock this whole opportunity? It's certainly not going to be overnight. It's extremely important that we have now very large issuances. I think that's when the eyes will turn in a bigger way towards municipal corporations. We need to have those kind of large success stories coming in a repeated manner. 100 crore, 200 crore just doesn't catch the eye of most of the readers or investors. It's all private placement in a larger way. So it doesn't really hit the market. So we need to have some of those very large issuances to tilt towards municipal corporations, and I think that's what will be required. Regulators, outreach initiatives, and where we've also participated quite a bit. All of these are again something which are encouraging the cause. I think this is going to hold on its grounds for some more time. We've kind of covered everything. I think you've missed anything in particular, be it comparison with US and all of that.
I mean, it's been a wonderful conversation. You were very patient with my questions. So I thank you for that.
Thanks, Kashish. Hope it was good enough.
Yeah, ma'am. I thoroughly enjoyed it. And I hope the audience will too. Thank you so much.
Thanks so much.